Hello, everyone. This is Natalie Madela, Associate Editor of Auto Finance News. Thank you for joining us for today's webinar entitled Risk and Opportunities for Marketplace Auto Lending. This is presented by the Center for Auto Finance Excellence, which is the industry resource for best practices and actionable advice for auto finance professionals. This is the second in our four-part 2016 series of webinars and is presented by the Center for Auto Finance Excellence through the support of Fiserv and DataScan. I would like to take a moment to thank Fiserv and DataScan for their generosity. We greatly appreciate it. The substance of this teleconference harkens to just some of what we do at the Center for Auto Finance Excellence. The Center was launched in 2013 by Auto Finance News and Fiserv for the benefit of the auto finance community. The Center shares its content through events like this and at autofinanceexcellence.org, which we encourage you to join. Our goal is to share unique content and insights on the practice of auto finance, furthering the overall management performance of the industry. Fresh articles are added to the site all the time. Some of the more recent articles delve into how behavior analytics can trim risk, the do's and don'ts to tackling compliance exams, and what makes a mobile app great. The information we cover today will also provide a taste of what you'll experience at the upcoming Auto Finance Summit, which will take place October 5th through the 7th in Las Vegas. You can visit autofinancesummit.com for more information and to register. We encourage you to share the link to this webinar on autofinanceexcellence.org with your colleagues. During this webinar, we're going to address the integration challenges that exist for traditional lenders looking to adopt a marketplace lending model, the legal implication of Madden versus Midland, and the current assessment of investor demands. Let's get started. It is my great pleasure to introduce our speakers, Scott Pearson, a partner at the law firm Ballard Spahr LLP, and Robert Shaw, director at PwC. I'm really pleased to turn this over to them. So Robert, please take it away.
Thank you, Natalie. So as we look at the integration challenges for traditional lenders in this space, it's not just marketplace lenders that are disrupting the model. It's really, the disruption is coming from a lot of different places, and it's a shift from analog to digital to omni-channel. So there's definitely four challenges that, and there's a myriad of other ones that need to be addressed, but the big four really in my mind are complexity. And complexity is really around the legacy architecture that has been established for many years. And we're seeing a lot of different firms make changes in their layers of architecture and try to simplify them. But this is really a shift from legacy architecture, the back office, large infrastructure, to a software as a service model to reduce the cost of service, the cost to originate. And the fintech players that are out there, the marketplace lenders and other fintech players are really spending a large amount of money in simplifying their architecture and moving away from the dependency on large infrastructure. And in a lot of cases, this infrastructure is costing companies between 35 and 40% of their overall budget. So reducing that has a direct impact on the reduction of operating costs and improving profitability. A second challenge that we're seeing is a lot of firms are product-centric. So if you look at the online marketplace lenders as an example, they're really started with unsecured lending and have moved up the credit spectrum into auto lending, into mortgages, and it's really platform-based, and it's really an extension of the platform versus moving across the product life cycle, which is how I would say a lot of lenders are out there and have moved across through acquisition. Another big challenge are the data silos that exist. So traditional lenders have set up their businesses across products, and those products have a lot of data that stays in there, and it's not really enterprise related, it's very product related. So credit performance, customer experience, everything is unique across each individual silo, and there's not this enterprise view of data as we move across. And then the last one really that's important is the operating model. So that if you look at someone like, well, just use Bank of America or JPM or someone like that have built their models through acquisition, they cobbled these operating models together to build one large monolithic organization. And these operating models are expensive to run, and frankly, there's a lot of room for operational efficiency. And if you look at the marketplace lenders, for example, it's got a very simplified model. Now the volume isn't there yet, but they're able to use their platform to deliver on a customer experience and overall customer experience that's in a lot of ways superior to what the large institutions are able to do. So if we look at some of the key themes that are moving across, they're helping alleviate some of the integration challenges. You have this omni-channel view where the customer comes into a portal or on the web, on a phone, through a branch, whatever the case may be, and it's the same seamless experience across the experience. And a lot of these fintech players that are out there really driving this experience off of some of the early customer experience, I would say they're probably higher in customer experience, and it really started with a customer-centric experience as they developed their operating model. So Amazon, Apple, Uber all developed a concept around a shared economy or their product around building a solution that satisfied the customer's needs versus satisfying the company's needs. The customer-centric piece is really a shift from the product view, which is, deliver the customer what they want when they want it, and you'll create a stickiness in the marketplace. The other piece is this data-driven model, which is using the big data within these companies. If you look at from a traditional standpoint, there's a tremendous amount of data at an enterprise level that can be used to improve the customer experience, or from a target marketing perspective as they're looking to extend into product areas where they haven't been. So if you look at the marketplace lenders, they can take this data that they've been able to use to build their unsecured portfolio and target market areas like auto or mortgage where customers, they already have a relationship. They're using that data to build out, to further extend their platform by using data. And then they're product agnostic. So they're not really underwriting, they're underwriting the customer and not the product. And this is a concept that I think, in particular the regulatory bodies will be interested in, because as you underwrite the customer, the relationship changes, and it's really giving the customer what they want when they want it, versus trying to push a product on a customer because they may need an unsecured loan, or they may need an auto loan, or they may need something else. You're just underwriting the customer and saying, here are your options, and you can pick. And the marketplace lenders, frankly, have done a very good job of satisfying that. Most of the loans that have started out in unsecured or are solving a problem in most cases, at least the data that is available points to, is debt consolidation or moving a student loan into rewriting the loan so it's in better terms for the consumer. So if you look at these four across, it's really changing the operating model from a traditional standpoint and taking advantage of some of the best practices and leading edge technology that or solutions that these fintech players have offered up, including the marketplace lenders. And finally, as you look at the operating model, I think there's some core themes that you want to look at as you're developing and transforming your business from a very analog business into a digital business and ultimately into an omni-channel business. I think, as we start, if you look at the operating model, it's omni-channel. You're looking at application and scoring that's underwriting a customer, not a product. Your offers and acceptance are based on a myriad of options for the consumer, and then you're able to fund that quickly, which is always, I guess, recently in particular, been a challenge given the regulatory environment. You have a shared services model at the bottom that takes advantage of scale from a legal compliance standpoint, risk, HR, customer analytics. The servicing and support that goes in the back office and even the front office is shared across your product life cycles. And it's platform enabled, which means, and this is where the marketplace lenders in particular have an advantage, is in that their platforms are seamless across products and they move in and out of and extend very easily. And then some of the other key characteristics you see are straight through processing. So when you submit an application, you get an answer fairly quickly because of the risk models and the credit models that are in place. It goes through and the decision engine it picks this up and puts the offer out relatively quickly. So if you're asking me what the biggest challenge is from an integration standpoint, it's unwinding the legacy architecture, because if you look at where the investment is right now in financial services, it's really shifting to a digital platform. But the biggest challenge is unwinding this architecture to make it more flexible, to allow for straight-through processing, to give you the ability to move in and out of products, and then use the analytics, the customer analytics and the data to give the customer a myriad of options in terms of products and services. So if we shift to the current investor demand, there are a number of factors that have negatively impacted the demand for marketplace lending. And a lot of these are around headline risk. So especially in the last 3 or 4 months and the ending of the first quarter, there were a number of issues out there that were driving headline risk. There's a supply and demand imbalance. So you see a lot of the private equity firms and the hedge funds moving out because they need to meet their own expectations around redemptions and so forth. And then the diversification that is needed for long-term survival. So you're really seeing a shift from the marketplace fintech model to a more traditional model, because diversification is really needed in order to really survive and go through the credit cycles and ebb and flow in and out of products, and still maintain a risk profile that allows investors enough return to enable them to invest. Finally, I wanted to leave this. I found this quote in a publication not too long ago that I think is relevant. And one of these big risks is around regulatory uncertainty. And it's the same for auto as the CFPB comes in and have made a number of changes to it. And there's still a number of unknowns out there that need to be considered. But I think from a marketplace lender, this is probably where auto was 2 years ago. So Mary Jo White said marketplace lending has impacts beyond investor and security industry. There are many consumers and banking considerations. This is why we engage with our fellow financial and consumer protection regulators, including the Department of the Treasury, Federal Reserve, CFPB, OCC, FTC, and FDIC, to develop a broad understanding of online marketplace lending industry and regulatory initiatives that would enhance investor, consumer, and borrower protection. So I think there are a lot of eyes on this from a regulatory perspective. I'm certainly not a regulatory expert, and we'll get to Scott in just a minute. But I think the implications to the operating model, the way financial institutions engage with customers, and the overall consumer protection of this is going to shift the way marketplace lenders look. So if in my mind, what they look like 2 years from now is probably going to be more closely resembling what a traditional financial institution looks like. So what I'd like to do now is turn this over to Scott and have him go through some of the regulatory implications as well.
Terrific. Thanks very much, Robert. Okay. So I'm going to cover just 3 of the most prominent regulatory issues that marketplace lenders face. Marketplace lenders have to comply with a whole panoply of regulations of the lending business that apply to any lender. If you're making consumer loans, you need to comply with all of the various federal consumer protection statutes like the Truth in Lending Act, the Truth in Savings Act, the Fair Debt Collection Practices Act, et cetera, et cetera. It's quite a long list. If you're engaged in small business lending or commercial lending, then there's not quite as much to comply with, but still there is quite a bit of federal regulation that you need to comply with. But because you're dealing with businesses and because we have always viewed business lending to be quite different from consumer lending in that businesses often have the protection of the corporate form, They tend to be more sophisticated than consumers, and the very nature of business is that you're taking a risk and it's not something that puts your household in jeopardy. There's not quite as much regulation on the business side of things. But the three issues that I want to cover are the Madden versus Midland funding case, which has received quite a bit of press attention, what we call the true lender issue, and then state licensing. These are really the three big structural issues that every marketplace lender needs to deal with when they decide how they want to structure their business. So let's start with the Madden case. Madden versus Midland funding is a decision from the Second Circuit Court of Appeals, which covers New York, Connecticut, and Vermont. The decision has not been followed outside the Second Circuit. It's a relatively recent case, and it's currently on appeal to the U.S. Supreme Court. So there's very much of a question as to whether or not the Madden case has legs. Notwithstanding that fact, particularly because it's from the Second Circuit, which is a very influential circuit, and it's the circuit that includes New York City, the decision has really impacted the industry quite a bit, and all of the institutional investors who are buying loans off of marketplace lending platforms, who are providing credit facilities for balance sheet lenders, and who otherwise are involved in the business, have been paying very close attention to the Madden case, as have marketplace lenders themselves. Madden involved the sale of credit card debt by a national bank to a non-bank. It's not a case that challenged the structure being used by a marketplace lender for the loans that it makes. It challenged the issue of whether or not a purchaser of defaulted debt could still charge interest as if it were a bank, essentially. And, you know, I think the easiest way of understanding what the issue is it's sort of like saying that if somebody who has a driver's license sells a car, the license doesn't follow the car. So just because you've bought a car from somebody, yeah, you can buy the car, but that doesn't mean that you have a license to drive it. That's essentially what the Madden case says. It says that just because a loan is originated by a national bank, when it's sold to a non-bank, that non-bank does not have the authority to continue to charge interest using the national bank's powers, which allow it to charge interest at the rate permitted by its home state under its home state's usury law. And the rationale for that decision from the Second Circuit is that essentially this would allow an end run around state usury law, which is something that we shouldn't allow for public policy reasons. Now, notably, the record of the Madden case below is really not very good. There was not extensive briefing of preemption under the National Bank Act, and that's one reason why a lot of people question whether the U.S. Supreme Court is going to take the case. And it's a very controversial decision as well, because there's contrary authority, particularly an Eighth Circuit decision called Crispin. And then there are two really well-established principles. One, that usury is determined at the time that a loan is originated. It's not determined later. And so just because a loan is sold to someone else, a loan is usurious or not usurious at the time it's originated, and that shouldn't change based on who owns the loan. And then secondly, there's this common law principle of that the assignee steps into the shoes of an assignor. When you transfer something to someone else, then they get the rights that you had, and the Madden decision runs contrary to that. As I indicated before, there is a cert petition pending before the U.S. Supreme Court. The court asked the U.S. Solicitor General to file a brief expressing the views of the United States on whether or not cert should be granted. That brief was filed recently by the Solicitor General and also by the Office of the Comptroller of the Currency. And it's a pretty interesting brief because it says that the court should not take the case because the record below is not adequately developed, and also because there's not a pure split in the circuits, but it unequivocally says that the Madden decision by the Second Circuit was wrongly decided and ought to be reversed. So a lot of people think that that brief, really ought to give some comfort to institutional investors, given that now the OCC has expressed its position, and typically courts will defer to the OCC. Let me now talk briefly about the true lender issue. This is essentially a form over substance issue. Quite frequently, marketplace lenders, when they make loans, the marketplace lender is not really a lender. What the marketplace lender is doing is it is working with a bank that is actually making the loans to customers, and the marketplace lender typically serves two functions. One is as essentially, a finder or a broker bringing in customers to the bank to get loans on the front end, and then on the back end servicing the loan, accepting payments and all of that. So the marketplace lender in that sense is really not lending, it is not the bank, and so the argument is that since the loan is being originated by a bank, you ought to look at the bank's powers and you ought to determine whether or not the loan is lawful or not in terms of interest rates being charged and things like that based on the bank charter. The true lender issue essentially says, well, this is all a sham. Pejoratively, people refer to it as rent-a-charter or rent-a-bank, and say, look, the marketplace lender is buying every single one of these loans immediately after it's made, and we should just disregard the fact that the bank is making the loan. It's actually a highly fact-specific issue. There are a number of different cases out there on this issue. A lot of the cases don't involve bank partnerships. They actually involve partnerships with Native American tribes and their sovereign immunity. Some of the cases involve banks, but a lot of these cases involve, extremely high interest rate lending, payday lending or other kinds of very high cost installment lending. But the general concepts are the same, and the ultimate question here is, is there a risk that the fact that this loan is being made by a bank going to be disregarded by a court? And regulators have expressed interest in this issue recently. Lastly, state licensing. This is a significant issue for marketplace lenders, regardless of whether they use a bank partnership. Every state, or virtually every state, has a state bank regulator that has some kind of licenses that they want people to get. Even if you are using a bank model for your loans as a marketplace lender, you typically need to get some licenses in some states, perhaps as a debt collector or as a servicer or as a broker. And so, there is quite a bit of exposure potentially if you don't have the right licenses. So it's an important issue for marketplace lenders to get guidance on. And this is particularly an issue if you have a true lender claim brought against you. If you are really making the loan, if we're going to disregard the fact that a bank is the lender for the loans being made in a marketplace lending program, then, are you really making loans without a license? And that's what that question is. So with that, I will turn it back for questions.
That was great, gentlemen. Thank you for sharing all that with us. I thought I would follow this up with some presentations with a few questions, if that's okay. And I'd like to start with Robert. Robert, in your presentation, you addressed some of the challenges traditional lenders will face, but if you had to boil it down, what would you say would be the most challenging thing traditional lenders will have to overcome?
Yes, I think that's a good question. I think it really depends on the lender, but for the most part, I think there are a couple of things that come together. One is the complexity of their infrastructure and their legacy architecture. I think the other one is a mindset. Becoming a digital or an omni-channel organization is a lot different than for a traditional lender than it is for, say, a marketplace lender that's been in business for 5 or 10 years, because that foundation, that entrepreneurial spirit that it moved the marketplace lenders into the space and encouraged all the investment that occurred is different than the traditional lenders who started with solving a problem and then grew, from there. So if you look at the OEMs, for example, and their captive finance companies, they're much different. Their business edict and their mindset is a lot different than, say, a bank that happens to have auto loans or unsecured loans or mortgages or whatever the case may be. So I think those are the two things that I would say. One is the mindset around at the top of the house around becoming a digital financial services company and delivering products and solutions and customer experience through an omni-channel experience are the two things that I would say.
Great, thanks, Robert. And for my next question, could be for either of you, but Scott, I think I'd like to start with you. Until recently, marketplace lending was considered a successful financial industry that has experienced tremendous growth in recent years. So with that in mind, why has it taken so long for the model to come to auto finance lenders, either as existing marketplace lenders launching auto products or auto lenders adapting a marketplace lending model?
Well, it's a good question. I think that you need to remember that a lot of auto finance occurs at the dealership, and so for that reason, I think that there's a little bit of a barrier of entry or barrier to entry for a marketplace lender. But that being said, we're working with marketplace lenders who are in the auto space, and I don't think there's any question that this is something that's going to be offered in the near term.
Great, thanks, Scott. And Robert, was there anything you wanted to add to that?
Yeah, I think if you look at the dealer model is definitely a huge differentiator from what traditional marketplace lenders have done, and their platform is able to handle auto lending. I think the dealer is the piece that they'll get tripped over. But even as recently, you're starting to see the OEMs look at someone like Tesla, who has a really disruptive model, even all the way down to their retail channel, and saying, how can we mimic that? So whether it's Cadillac or Lexus or other nameplates, looking at that model and saying, how can we become profitable in a virtual network or a retail channel that is different than our traditional model? And clearly, there's some franchise laws that have to be negotiated and overcome to get there, but OEMs are taking notice of that, and I think that dealer model is ripe for disruption as well.
Great. And Scott, my next question, in Marketplace, lenders primarily have worked one of two ways, using a bank partner to originate loans or becoming licensed in each state in which they extend the loans. We've discussed Midland versus Madden, and already Lending Club has altered their origination model. What model do you suggest for lenders that are looking to launch a marketplace model?
Well, I don't think that there's a one-size-fits-all answer to that question. I think you need to look at the business that the marketplace lender is in and who's their customer base and what kind of products are they focused on. The answers may be very different, for example, depending on what kind of interest rates the lender is going to need to charge based on the risk profile from its customers. There are a number of states where, certain types of products just would not be offered at all if you didn't have, the opportunity to get a bank involved. So with respect to the question of, how do you structure a bank partnership, that's a very complicated question where we need to work with lenders one-on-one to figure out what makes the most sense for them. That being said, right now, given the current regulatory environment, which has some uncertainty, we do think that it would be prudent for marketplace lenders to find an arrangement where the bank is willing to keep a percentage of the loan on its books permanently, so that rather than selling a whole loan, the bank is selling a participation interest and keeping a substantial portion of the loan on its own books. The challenge right now is that there just are not really a whole lot of banks that are prepared to do that, so that may or may not be an option. But, look, this is a very rapidly evolving area. We're working with lots of clients right now on changing their models in response to what's going on in the market and also what's going on in the regulatory environment. So the answer that I give you today may not be the same answer that I would give you 6 months from now.
Great. And Robert, on May 10th, the Treasury released a white paper entitled Opportunities in Online Marketplace Lending. The white paper identifies potential trends that will require ongoing monitoring, and among those trends was auto loans originated by online marketplace lenders. What could this mean for regulatory insight, and I mean, is that regulation coming?
So I think it goes hand in hand with the broader regulation of not only the marketplace lending, but if you look at what CFPB's edict is to provide the consumer transparency and ensure that companies that are offering these loans are providing, the transparency that's required so consumers are making the best decision based on the information in front of them. I think I would really say this is probably the CFPB in particular, while they're taking an interest, are probably going to be still more focused on, your mortgage industry, and auto certainly is in there as well as we look at disparate impact and other regulations that are out there. I will say that marketplace lenders should keep a close eye on this to see how that's going to impact their business, and along with all the other regulatory issues or legal issues that Scott spoke about. I think you really can't disassociate any of it without taking a long view of what the implications are to your business and the business model. So while marketplace lenders are extending into auto lending, I think the overall impact of the regulations and the legal implications of their business model are going to continue to evolve with the regulations, and they're also going to have to change based on what traditional lenders are doing as well as a reaction to their growth.
Okay, and Scott, was there anything you wanted to add to that as well?
No, I don't think so. I mean, as I've indicated, it's a very rapidly developing area. There's a lot of federal interest. There's a lot of state interest. And, candidly, I think it remains to be seen exactly where we're going to end up. Look, I think that all of the players in this industry are well aware of what the environment is. And the important thing is for them to focus not only on where we are now, but where we're going to be in 6 months or a year, and start modifying their businesses to comply with what will be the new normal.
And then, Robert, you work with lenders looking to move into more digital processes. Have you seen increased interest in marketplace lending from traditional lenders, or are we likely to see more startups enter into the space?
So I think it's a good question. I think from a traditional standpoint, I think the movement from, let's say, their traditional model to a digital model is probably just a normal transformation cycle. As they move from analog to digital and now digital to omnichannel. It's less driven on marketplace lenders. It's more driven on their platform. It's probably more closely related to their platforms and the things they're able to do with the platform, the way they handle data, the way they deliver a customer experience that's differentiated, and the way that they're able to incent investors to continue to invest in their products. So there's interest there. I think it's more around the enterprise platform and how they're delivering their services to the market, and less about marketplace lenders. I think there's still an interest there, and if you speak to banks in the conversations I've had with banks and other auto lenders, they're really interested in marketplace lending because it's getting a lot of attention right now, but it's more driven from the fintech offerings than it is what niche they're serving in terms of products and services.
And Robert, with the backlash in the media recently regarding marketplace lending, is there some cause for hesitancy among lenders, or in other words, is this just media hype or the wrong time to get into marketplace lending?
So I think the reason, you look at where the investment, I always say follow the money, right? So if you follow the money, I think the reason there was so much, I think Q1 in particular saw such a drop off in investment was more the internal investment requirements, you know, as I spoke about, the hedge funds needing to make their own returns to their investors, and less about the market itself and the stability in the market. Although the headline risk that's associated with some of the things, whether it be that are out there, there's some negativity, and there's still a lot of concern around the credit, running the entire credit cycle, for example, and what happens if the interest rates rise in the next quarter or so. What does that do to the portfolio and the demand for these types of loans? So I think it's a wait and see, but I think there is a transformation going on where these banks or these traditional marketplace lenders are having to diversify to really be more and more relevant to the market.
And Scott, was there anything you wanted to add to that as well?
Yeah, I think there's been a significant overreaction from the market. I think that there was some news about, you know, a small handful of companies that I think really got some serious traction for some reason. There's this perception that, you know, oh my God, the industry is in jeopardy and is it going to survive and all of that. The reality is that there are marketplace lenders who have been in business for a very long time and who have been through multiple credit cycles and who are doing very well right now and who are making money. I think that you very well may see some industry consolidation. I think that there is a lot of opportunity out there right now to buy low because of all of the turmoil in the market. The suggestion that these companies are just going away, I think, is really wrong. And with respect to banks, I think you're seeing a number of different approaches. You're seeing banks like Wells Fargo who are, you know, sort of launching their own, I'm not sure if I would call it a marketplace lending platform, but who are, you know, using technology and offering some products that compete fairly directly with some of the marketplace lenders. You're seeing others who are partnering with marketplace lenders with, you know, referral type arrangements. You see banks that are licensing platforms from marketplace lenders who are acting, you know, very much as technology companies and essentially licensing their software as opposed to, you know, focusing exclusively on making loans themselves. I think you're going to see a lot of different things, and I think that, you know, you've got that whole yin and yang thing going on where, you know, all the bad things have a good side to them, and I think you'll see some of these companies come out of this, you know, looking quite good and being much stronger than before the turmoil that started recently.
Great, thanks. And I have one final question for Scott. Does a hybrid model where half of the loans are funded by investment capital and half by lender's own balance sheet mitigate the, quote, true lender risk?
I'm not sure I would quite characterize it that way. You know, when you use multiple models, certainly if one of the models turns out to be flawed, I mean, let's say that you have a decision that comes down that, you know, basically torpedoes the bank partnership model, but you've also got a direct product that you offer. Well, you know, your company has not put all of its eggs in one basket, and to that, you know, to that extent, I think you've been smart and you've protected yourself by diversifying the products that you offer. I think that's how I would answer that.
And that actually concludes today's webinar, and thank you again, gentlemen, so much for joining us today.
That's welcome. Thank you.
Our pleasure.